The Federal Reserve just blinked. On May 2026, the Federal Open Market Committee released a statement that changed exactly 3 words from their April guidance. 3 words that most retail investors scrolled past without noticing. 3 words that institutional trading desks immediately recognized as the signal they've been waiting 18 months to see. The old language from April. The committee remains committed to maintaining current policy stance until inflation pressures are fully contained. The new language from May. The committee remains committed to maintaining current policy stance until economic conditions warrant adjustment. From inflation pressures fully contained to economic conditions warrant adjustment. Wall Street veterans know exactly what that language shift means. The Fed just opened the door to cutting rates before inflation hits their 2% target. After 2 years of higher for longer, after 14 consecutive months of holding the federal funds rate at 5.25%, the pivot has begun, and silver responded immediately. Within 48 hours of that statement, silver jumped from $81 to $86. Gold pushed above $5,900. But here's what almost nobody is connecting. If this is actually the beginning of the Fed pivot that markets have been anticipating since late 2024, we're not looking at silver consolidating at $86. We're looking at the early stages of a move that could push silver to $150 before Christmas. I know how that sounds. Aggressive, speculative, the kind of prediction that gets mocked if it's wrong and forgotten if it's right. But I'm not pulling that number from hope or hype. I'm pulling it from a specific historical pattern that has played out 3 times in the last 50 years. And every single time the Fed pivoted from restrictive policy to accommodative policy, while precious metals were already in an established uptrend, the move that followed was violent, vertical, and far larger than anyone predicted at the pivot point. Let me be clear about what this video is and what it's not. This is not a guarantee that silver hits $150. This is an analysis of what happens when you combine Fed policy reversal, existing supply constraints, and institutional capital repositioning in precious metals. If you run those 3 variables through historical precedent, $150 by Christmas is not only possible, it's the conservative midpoint estimate. But there are 3 specific conditions that must remain true for this scenario to play out. If any one of these conditions breaks, the entire thesis falls apart. I'll show you exactly what those conditions are and how to monitor them in real time so you know whether to stay positioned or get out before the crowd. Welcome to Money Untold. If you want to see how this plays out over the next 7 months, subscribe now. Because if I'm right, this will be the most important financial story of 2026. And if I'm wrong, you'll want to see exactly where the analysis broke down. Now let me show you why the Fed just lit the fuse on a $150 silver move. The Federal Reserve doesn't change policy language casually. Every word in FOMC statements is debated, revised, and approved by committee. So when they shift from inflation pressures fully contained to economic conditions warrant adjustment, it's not an accident, it's a signal. But here's what you need to understand. The Fed doesn't pivot because the economy is strong. The Fed pivots because something is breaking and they need to prevent systemic damage. So what's breaking right now that forced this language change? 3 data points the Fed is seeing that you're not hearing about. Since January 2026, commercial real estate defaults have accelerated to levels not seen since 2009. Office buildings in major metros are refinancing at interest rates 300 or 400 basis points higher than their original loans. Many can't make the payments. Regional banks, which hold approximately $1.8 trillion in commercial real estate exposure, are starting to show stress in their loan loss provisions. The Fed is watching this closely because commercial real estate defaults don't stay isolated. They cascade into regional bank balance sheets, then into the broader credit system. The 2008 crisis started with real estate. The Fed learned that lesson. Consumer credit card delinquency rates crossed 8.2% in Q1 2026, the highest level since 2010. Average credit card interest rates are above 22%, and consumers who've been carrying balances for 18-plus months at these rates are starting to break. When consumer credit breaks, spending collapses. When spending collapses, corporate revenues miss estimates. When revenues miss, layoffs begin. The Fed sees this chain reaction forming. This is the one that matters most, but it's technical enough that mainstream media doesn't cover it. Treasury market liquidity, measured by bid-ask spreads and market depth, has deteriorated 40% since Q4 2025. When the Treasury market becomes illiquid, the U.S. government's ability to fund itself at reasonable rates becomes compromised. This is a red line for the Fed. They will sacrifice inflation targets before they allow Treasury market dysfunction. These 3 conditions, commercial real estate stress, consumer credit deterioration, and Treasury market illiquidity, are why the Fed just changed their language. They're preparing markets for rate cuts, not because inflation is solved, but because financial stability risks are rising. And here's the critical connection to silver. When the Fed cuts rates while inflation is still above target, they're effectively admitting they're choosing financial system stability over currency stability. That's the exact environment where monetary metals go vertical. Let me show you the 3 historical precedents for Fed pivots occurring while precious metals were already in established uptrends. Because what happened next in each case will show you exactly why $150 silver by Christmas is not speculative fantasy. Context: coming out of the 1973-75 recession, inflation remained elevated around 6-7%. The Fed began cutting rates in late 1976 to support economic recovery, despite inflation still being well above their target. Gold was trading around $120. Silver was around $430. What happened next? Over the following 38 months, gold went from $120 to $850, a 608% gain. Silver went from $430 to $50, a 1,063% gain. The most explosive phase occurred in the final 14 months after it became clear the Fed would not raise rates aggressively enough to contain inflation. Key lesson: when the Fed pivots to accommodation while inflation is still elevated, precious metals don't move linearly. They consolidate, then explode in the final phase. Context: the Fed began cutting rates in September 2007 as the housing market deteriorated. They cut from 5.25% to 2.25% over 6 months. Gold was trading around $720 when cuts began. Silver was around $12.80. What happened next? Over the following 10 months, gold went from $720 to $1,030, a 43% gain. Silver went from $12.80 to $20.50, a 60% gain. The move was interrupted by the Lehman collapse forced liquidation, but the directional thesis was confirmed. Fed accommodation during financial stress is jet fuel for metals. Key lesson: Fed pivots driven by financial stability concerns, not economic strength, produce outsized precious metals moves because they signal currency debasement is the policy path of least resistance. Context: the Fed cut rates 3 times in late 2019 despite unemployment being at 50-year lows. They claimed it was insurance cuts, but the reality was repo market stress and slowing global growth. Gold was trading around $1,120, silver was around $1,620. What happened next? Over the following 12 months, gold went from $1,220 to $2,070, a 46% gain. Silver went from $1,620 to $29.50, an 82% gain. The COVID crisis accelerated the move, but the trajectory was already established before the pandemic. Key lesson: Fed cuts that begin as precautionary often become sustained easing cycles because the underlying financial stress is worse than initially acknowledged. Metals front-run this realization. Now let's apply this historical framework to May 2026. Silver is currently at $86. The Fed just signaled they're opening the door to rate cuts despite inflation still running above 3%. Commercial real estate is stressed. Consumer credit is breaking. Treasury market liquidity is deteriorating. If we apply the most conservative historical analog, the 2007-2008 case, where silver gained 60% from pivot signal to peak, that would put silver at $138 within 10 months. If we apply the average of the 3 cases, about 535% across all 3, averaged to roughly 178% per instance, divided by 3, or 59% average single-cycle gain, we get to 136. But here's why this cycle could exceed those historical precedents. In 1976, 2007, and 2019, there were no significant physical silver supply constraints. Industrial delivery timelines were normal. Exchange inventories were adequate. The moves were driven purely by monetary policy and financial stress. In May 2026, we have monetary policy reversal and physical supply constraints and record low exchange inventories. We have all the historical catalysts plus structural supply deficit. That's why $150 is not the outlier estimate. It's the midpoint scenario if the physical supply situation continues deteriorating while the Fed cuts rates into still elevated inflation. If this historical analysis is connecting the dots for you, hit that subscribe button and turn on notifications. When silver crosses $120, the mainstream media will finally cover this story, but by then, the easy part of the move will be over. Now let me show you the timeline. Christmas is 7 months away, December 25th, 2026. If silver is going to hit $150 by then, it can't happen in a straight line. Markets don't work that way, so let me walk you through what the path would look like month by month, based on how previous Fed pivot cycles unfolded. May 2026, current, $86, the recognition phase. We're here now. The Fed just signaled policy shift. Early institutional capital is repositioning. Retail hasn't fully recognized what's happening yet. Physical premiums are elevated but not explosive. Silver consolidates between $80 to $90 as the market digests the FOMC language change. What to watch? June FOMC meeting preview. If Fed officials begin publicly discussing rate cuts in their speeches, it confirms the pivot is real, not just dovish language. June 2026, 88.98, the confirmation phase. The June FOMC meeting either confirms rate cuts are coming, likely a 25 BP cut in July, or walks back the May language change. If they confirm, silver breaks above $90 and heads toward $95 to $98 as macro funds begin adding precious metals exposure. Physical market signals intensify. If COMEX registered inventory continues declining and July delivery notices exceed May levels, the supply constraint narrative gains institutional credibility. What to watch? Actual Fed rate decision in June. If they cut, the path to $150 accelerates. If they hold but signal July cut, timeline stays on track. If they walk back dovish language, the entire thesis is invalidated. July 2026, $95, $110, the acceleration phase. Assuming June confirmed rate cuts, July is when momentum builds. Retail investors finally notice silver has moved from $86 to $95 in 6 weeks. Google Trends for silver price spikes above 200. Financial media begins coverage. This is the dangerous phase. FOMO buying from retail can push silver to $105, $110, but it can also attract profit-taking from early institutional buyers. Volatility increases. Daily swings of $5 to $8 become normal. What to watch? CME margin requirement changes. If the exchange raises margins to cool speculation, expect a sharp 10-15% pullback that shakes out leveraged retail. That pullback is a buying opportunity if the fundamental thesis remains intact. August 2026, $100, $115s, the consolidation phase. After the July run-up, silver needs to consolidate. Expect a pullback to $100, $105 as weak hands get shaken out and institutional capital accumulates the dip. This is where most retail investors who bought at $108 panic sell at $102. If the physical supply constraints are real, premiums will stay elevated even during price consolidation. If premiums collapse during this pullback, it signals the move was purely speculative and the path to $150 is unlikely. What to watch? Shanghai and India physical premiums. If they stay above 6% during a price pullback, it confirms structural supply deficit. If they narrow to 2 to 3%, the thesis is weakening. September-October 2026, 115, 135s, the breakout phase. This is when silver makes the move that breaks it into mainstream consciousness. A sustained push above $120 brings in a new wave of institutional capital, pension funds, sovereign wealth funds, family offices that couldn't justify exposure at $86 but can't ignore it at $125s. Media coverage intensifies. You'll see primetime CNBC segments, Bloomberg cover stories, and the inevitable "Is silver the new Bitcoin?" articles. What to watch? Gold-silver ratio. If silver is outperforming gold and the ratio compresses below 55:1 from current 68:1, it signals silver is leading the precious metals complex. That's a bullish confirmation. November 2026, $130, $150, the climax phase, the final push. If we've made it this far with the Fed cutting rates, physical supply still constrained, and institutional capital flowing in, silver makes the final run to $140, $150. This is also the highest risk phase. Climax moves are characterized by euphoria, vertical price action, and eventual exhaustion. When your barber starts asking about silver, we're near the top. What to watch? COMEX rule changes. If the exchange announces emergency measures, position limits, forced liquidation, settlement modifications, it signals the paper system is breaking. That could push silver above $150 short term, but it also signals extreme instability and likely reversal. December 2026, $150 target window. If the thesis plays out, silver touches $150 sometime between December 1st and 20. Not on Christmas Day, markets don't work that precisely, but within the Christmas window. Whether it sustains $150 or immediately reverses depends on what happens at the exchange level and whether physical supply constraints have actually been resolved or just repriced. I told you at the beginning there are 3 specific conditions that must remain true for the $150 scenario to play out. If anyone breaks, the thesis is invalidated. Here they are. Condition 1. The Fed must actually cut rates. The May language change is a signal, not a commitment. The Fed could still reverse course if economic data strengthens or if inflation reaccelerates. Invalidation trigger. If the June or July FOMC meeting results in no rate cut and the Fed removes the economic conditions warrant adjustment language, the pivot is dead. Silver would likely pull back to $75, $78 within weeks. How to monitor? Watch the CME FedWatch tool. It shows probability-weighted expectations for Fed rate decisions based on futures pricing. If the probability of a July rate cut drops below 40%, the pivot thesis is weakening. Condition 2. Physical supply constraints must persist. The $150 thesis is built on the combination of Fed accommodation and physical supply deficit. If supply constraints ease, if COMEX registered inventory increases significantly, if industrial delivery timelines normalize, if physical premiums collapse, then this becomes a purely monetary policy play. And purely monetary policy plays rarely produce 75% gains in 7 months. Invalidation trigger: if COMEX registered inventory increases above 70 million ounces from current 52 million, or if Shanghai physical premiums drop below 3% for more than 2 consecutive weeks, the supply constraint narrative is broken. Condition 3. No exchange rule changes that disrupt price discovery. If silver approaches $130, $140, and the move is driven by physical delivery pressure on COMEX, the exchange has the authority to change rules mid-game. They did it in 1980, Hunt Brothers. They did it in 2011, margin increase spiral. Any CME announcement regarding position limits, margin requirements above 30%, or changes to delivery settlement procedures. These signal the exchange is intervening to prevent further price appreciation. If all 3 conditions remain true through September, the probability of $150 by Christmas moves above 60%. If even one condition breaks before July, the probability drops below 20%. Let me steelman the bear case, because if you're making decisions based on this analysis, you need to hear the strongest counter-argument. Bear case argument. 1. The Fed language change was dovish posturing, not policy shift. The Fed has a credibility problem. After claiming inflation was transitory in 2021, they've been trying to rebuild trust. The May language change could simply be an attempt to appear flexible and data-dependent without actual commitment to cutting rates. If June and July economic data comes in stronger than expected, the Fed could easily hold rates at 5.25% through the end of 2026. In that scenario, silver at $86 is overvalued, not undervalued. We'd see a pullback to $70, $75, not a rally to $150. Bear case argument. 2. Physical supply constraints are temporary logistics issues. The delivery delays and elevated premiums could be supply chain friction, not structural supply deficit. If mining production increases in Q3 2026, several major silver mines are scheduled to come online, and if logistics normalize as post-COVID supply chain issues fully resolve, physical tightness could evaporate quickly. Without the physical supply component, silver becomes just another commodity responding to macro conditions, and commodities rarely double in 7 months without speculative mania. Bear case argument. 3. $86 silver has already priced in the Fed. Pivot markets are forward-looking. Silver moved from $68 to $86 in the past month. That 26% move may have already priced in the rate cuts that are coming. If the Fed cuts in July and silver doesn't move higher, it confirms the rally was anticipatory and we're due for sell the news profit-taking. In this scenario, $86 is the top, not the midpoint. We consolidate here for months, then drift lower to $75, $80 as the rate cut narrative gets fully absorbed. My response to the bear case: all 3 arguments are logically sound. I don't dismiss them, but here's why I weight the bull case higher. The Fed's language change occurred after 2 consecutive months of economic data deterioration, commercial real estate, consumer credit. That's not posturing. That's reaction to real financial stress. Physical supply constraints have persisted for 6 weeks while prices rose 26%. If it were purely logistics, higher prices would have resolved the delays. They haven't. And regarding whether $86 has priced in the pivot, historical precedent says no. In 1976, 2007, and 2019, metals continued rallying for 38 months after the first rate cut. The initial move up is recognition. The sustained rally is the consequence of policy working its way through the system. But I could be wrong. That's why the invalidation triggers matter. Let me give you specific, actionable guidance for different types of investors. Because silver could hit $150 is useless without a framework for how to position. If you don't currently hold silver and you believe this thesis, Do not buy $86 silver with your entire allocation expecting a straight line to $150. That's gambling, not investing. Instead, take a 30% position now at $86, set limit orders to add another 30% if silver pulls back to $80. Reserve final 40% for a breakout above $100, confirms momentum is real. This scaled approach ensures you have exposure if the thesis plays out immediately, but you're not destroyed if we get a violent pullback first. If you currently hold silver purchased below $70, you're sitting on 20% plus unrealized gains. Here's the disciplined approach. Take 25% profits at $86 to de-risk and lock in gains. Hold the remaining 75% with a trailing stop at $78. If silver breaks above $100, move your stop to $92. If it breaks above $120, move your stop to $110. This protects your capital while giving the thesis room to develop. If you bought silver recently between $75 and $85, you have minimal margin of safety. The worst thing you can do is panic sell on a 10% pullback or FOMO, buy more at $90. Instead, hold your current position with a hard stop at $74, just below your cost basis. Do not average up unless we break above $95 with confirmed volume. If stopped out at $74, reevaluate whether the three conditions are still intact before re-entering. If you want to trade this actively, high risk, use options, not futures. Futures leverage will destroy you in a volatile move. Silver call options with December 2026 expiration give you exposure to the upside while limiting downside to premium paid. Example structure. By December 2026, $100 calls, currently around $8 to $10 per contract. If silver hits $150, a $100 call is worth 50 plus 5x return. If silver drops to $70, you lose your premium but nothing more. Do not use margin. Do not use leveraged ETFs like USLV or AGQ unless you're prepared for 30-40% intraday swings. What I'm personally doing, full transparency. I currently hold a core physical silver position, purchased between $50 to $68, 2024-2025 accumulation. I took 20% profits at $84 2 weeks ago. I'm holding the remainder with a trailing stop at $78. If silver breaks above $95, I'll take another 15% profits and tighten the stop to $85. I'm not betting the farm on $150, but I'm positioned to capture it if it happens while protecting against a reversal. Here's the honest truth about bold predictions in financial markets. They're either spectacularly right or quietly forgotten. If silver hits $150 by Christmas, this video will get shared everywhere. I'll look like a genius, and everyone will claim they saw it coming. If silver is trading at $75 by Christmas, this video will disappear into the algorithm. I'll look like another permabull precious metals YouTuber, and the critics will have been right. I don't know which outcome we get. What I know is this. The Fed just signaled a policy pivot after 18 months of restrictive stance. They're doing it while inflation is still above target, which means they're prioritizing financial stability over currency stability. That's historically been the trigger for significant precious metals appreciation. We have simultaneous physical supply constraints that weren't present in previous Fed pivot cycles. We have record low exchange inventories. We have industrial delivery delays extending into Q3. And we have silver at 86R, which is either the early stages of a historic move or the exhaustion point of an extended rally that started from 18 in 2020. The difference between those two outcomes depends on whether the three conditions I outlined remain true over the next 90 days. I've given you the framework. I've shown you the historical precedent. I've provided the invalidation triggers so you know when to exit if the thesis breaks. What I can't do is guarantee that I'm right. What I can guarantee is this. If you're still watching financial news waiting for CNBC to tell you when to buy silver, you'll be at least 3 months late to the move. Institutional capital doesn't wait for Jim Cramer's blessing. The signal happened on May 14th when the Fed changed 3 words in their statement. Everything from here is just confirmation or invalidation of what that signal meant. I want to hear from you. Do you think $150 by Christmas is realistic, conservative, or delusional? Tell me in the comments what you think breaks this thesis. I'm especially interested in hearing from skeptics. Tell me where the analysis is wrong. Subscribe to Money Untold if you want monthly updates as this plays out. I'll be tracking the 3 conditions in detail and will tell you immediately if any invalidation trigger hits. And remember, conviction without humility is arrogance. Stay informed, stay disciplined, and don't bet money you can't afford to lose on any scenario, including this one. Let's see if the Fed pivot really is the catalyst that takes silver to $150 before Christmas.